May was another very strong month for stock markets. Despite all the headlines and uncertainty in the background, investors seemed as optimistic as ever that everything is going to work out just fine. So let's see how my portfolio performed. So the portfolio finished May at just over 898,000. That's an increase of 4,747 over the month, which this month was split fairly evenly between contributions and returns. My investment returns were 0.3% in May, which might not sound particularly exciting when stock markets are rallying strongly, but that's exactly what I'd expect given how the portfolio is currently positioned. Overall, though, another positive month, and it's nice to see the portfolio edging ever closer to that 900,000 mark. If we look at the actual portfolio performance, the portfolio returned 0.3% during May and was very, very steady throughout the month, which is generally what I'd expect from a portfolio positioned like this. The slight dip you can see on the chart is simply the TIPS fund going ex-dividend before paying out again at the end of the month. Without that, the line would have been almost completely flat. Global equities, on the other hand, had a very strong month, rising 6.5%. That's an extraordinary move for a single month, given all the uncertainty we've been seeing. RPI inflation was up 0.7% during the month. Now, I don't benchmark this portfolio against global equities. The benchmark I care about is inflation plus around 3% per year over the long term. And at the moment, I'm comfortable lagging equities because I'm not convinced the risk-reward is especially attractive at current valuations. So while 0.3% this month isn't particularly exciting, it's broadly what I'd expect from the portfolio as it's currently positioned. Moving on to the monthly movers, the strongest performer this month was the Jupiter Global Equity Absolute Return Fund, which was up 1.4%. The weakest performer, again, was the Argonaut Absolute Return Fund, which was down 3.6%. What's interesting is that neither of these are traditional equity funds. They're both absolute return strategies, but they go about generating returns in very different ways, which is one of the reasons I own both of them. This table highlights the Jupiter Fund's recent track record. After a difficult period between 2018 and 2020, it's now delivered 5 consecutive positive years, with annual returns ranging from 9 to 19%. The fund follows a market-neutral strategy, meaning it buys stocks it expects to outperform and short stocks it expects to underperform. The aim is to generate returns from the difference in performance between those positions, rather than relying on the overall stock market rising. The weakest performer this month was the Argonaut Absolute Return Fund, which fell 3.6%. This is the second month of being at the bottom of my portfolio. But rather than focusing on a couple of months of disappointing performance, I think this chart does a much better job of explaining why I own it. These are the 7 largest equity market drawdowns since the fund launched in 2009. The grey bars show how much equity markets fell, while the gold bars show how the fund performed during those same periods. What stands out is that in many of these difficult environments, the fund was actually positive while equities were falling heavily. During COVID, for example, the fund gained over 22%, while equities fell by a similar amount. During the inflation spike in 2022, it was also positive, while equities struggled. Now, that doesn't mean it will always perform like this in the future, but this is exactly the role I want it to play in the portfolio. It's there as a diversifier and as a potential source of returns during periods when traditional assets are under pressure. The fund is currently positioned long cheaper stocks and short more expensive stocks. So in months where expensive stocks are outperforming, then this fund will probably underperform, which is what has happened this month with equities flying higher. Looking at performance year to date, the portfolio is up 7.1%, which I'm very happy with given how defensively the portfolio has been positioned this year. Global equities are up 11.9%. That's a remarkably strong return considering some of the volatility and uncertainty we've seen during the first half of the year. Meanwhile, inflation has risen by 1.4%. As regular viewers will know, my objective isn't to beat global equities every year. My goal is to grow capital ahead of inflation over the long term while taking risk when I think the odds are in my favour. At the moment, I still think valuations look quite stretched, so I'm comfortable holding a more defensive portfolio, even if that means lagging equities during strong rallies like we've seen recently. I also suspect inflation may prove a little more persistent than many investors currently expect, so it'll be interesting to see how the inflation figure develops over the rest of the year. And that brings us to what changed this month. The short answer is absolutely nothing. There were no purchases and no sales during May. My asset allocation remains exactly the same as it was at the start of the month. I think one of the biggest mistakes investors can make is feeling the need to constantly do something. Markets move every day, the news changes every day, and it's easy to feel like you should be reacting to all of it. But in reality, investing is often a waiting game. My views on valuations haven't really changed. I still think equities look expensive, and I still think the risk-reward is more attractive in some of the defensive assets that I hold. So for now, I'm happy to sit patiently and wait for better opportunities rather than forcing decisions simply because a new month has arrived. This remains a very defensive portfolio. Around 40% is held in cash and short-duration bonds, 32% is invested in short-dated inflation-linked bonds, 24% is in defensive and absolute return strategies, and just 4% is held in gold. I know that's a very unusual allocation compared with most portfolios, particularly at a time when equity markets continue to push higher and everyone is getting rich. But I think it's important to remember that asset allocation should reflect both your opportunities and your concerns. And at the moment, my biggest concern is valuation. Equity markets are trading at levels that I think imply a very optimistic future, and that's not a bet I'm particularly keen to make right now. This portfolio is never going to outperform in a strong bull market. In fact, we've seen exactly that this month. But I'm okay with that as I wait for better opportunities. And finally, these remain the 5 largest positions in the portfolio. The largest holding is still the Amundi Smart Overnight Return ETF, and alongside the Treasury 2027 gilt, those positions make up a significant part of the cash allocation and reflect my desire to keep plenty of liquidity available. The iShares TIPS ETF and the PIMCO Global Low Duration Real Return Fund form part of the portfolio's inflation-linked bond bucket. And then the BH Macro remains my largest absolute return position. It's a global macro hedge fund, and it's one of the funds I own that I think has the potential to perform particularly well if we see a period of market stress or volatility. Taken together, these 5 positions represent around 70% of the portfolio, so they do a good job of telling the story of how the portfolio is currently positioned: liquid, inflation-aware, and defensively positioned, while waiting for more attractive opportunities elsewhere. As always, thank you for watching, and I'll see you again next month.